Hello and welcome back to another large cap portfolio update. My name is Ryan Hogan. I'm the large cap portfolio manager at the Oregon State Investment Group. We're a student-led investment group. We manage money on behalf of the school's foundation here at Oregon State University. It is week 3, October 13th, and the value of our portfolio in its entirety is $3.23 million. Here's our performance overview. Our weekly return this week was negative 2.22%. The S&P 500 returned about negative 2%. We underperformed the S&P. We had weekly alpha of negative 48 basis points. I've included this chart here because I believe it's important when there's times of uncertainty to zoom out. When in doubt, zoom out is the old saying. And we have more charts available up on the Box platform where we keep all of our data. Our year-to-date return is negative 22.72% versus the S&P of 21.85. Again, we're still within our margin of error there. Year-to-date alpha is negative 3.58%, so we're not doing as well as we'd hoped. Again, what this tells me is we're better off holding the risk-free security, which is the government bond. But the reason we don't do that is because we are a long-only U.S. equity portfolio who must employ between 90 and 98% of its allocated capital into U.S. stocks of market cap 10 billion or greater. Our one-year beta is 0.94. Our year-to-date beta is 0.89. Again, we're still under 1. But unfortunately, this week our Sharpe ratio took a massive hit at negative 1.01 versus the S&P at negative 62 or 0.62. This tells me we are really taking on a lot of risk, especially this last week, and we were really undercompensated for it. However, given our poor Sharpe ratio, we are still beating the S&P since we have started the fund back in 2007. We are up 223.15% versus the S&P being up 221.45% for the same time period. Going into the economic data in yield curve, as you can see, I've included the yield curve up here, and then the 30-year fixed rate mortgage average in the United States. I've also included what normal yield curves should look like down here, as well as a flat, inverted, and humped for reference. We are starting to see kind of a hump formation in the yield curve, which contributes to some uncertainty, especially in the debt markets when investors go to lend money. This is kind of a rare type of curve that happens when interest rates on medium-term maturities are higher than rates on both long and short-term maturities. Typically happens when interest rates are expected to rise and fall. The last significant time this happened was October 97, about 2.5 years before the tech bubble burst. Again, there's been a few other times that are more recent than that, but it was only for maybe a day or a week, and it was not for a prolonged period of time. The CPI index came in at 8.2% year over year, down from 8.3% year over year in August. We saw some explosive buying this morning despite being down at the open. Still missed expectations by 0.4%. So my guess is the Fed will want to raise another 75 basis points. Core inflation, which again excludes those volatile food and energy factors in its inflation count, rose 60 basis points to 6.6%. The Fed funds rate currently is 3.25%, and the next meeting is again November 1st through the 2nd, right after corporate earnings come out. Inflation year over year is at 8.5% versus 8.3% in June. So keep your eye out for the next CPI update. I've included the 30-year fixed mortgage rate because I just want to show you what these massive rate hikes have done to the housing market in the US. It's absolutely crushing first-time home buyers when they go to get a mortgage and apply to buy a house. Right now is not the time you want to be out in the housing market if you suspect that rates will come down eventually over the next, few years. It is absolutely crushing real estate. Here's our portfolio update. We have midterms and earnings season coming out, so get ready for a lot of news. Analysts, please know when your company reports. Over 800 companies will be reporting from October 24th through the 28th. And you have midterms directly after on November 8th, so expect volatility in either direction. My guess with the VIX being in the 30s, we're going to see the VIX come down. It's very hard to predict, future of really any financial instrument, but the VIX at 30, given, our tendency for markets to, move up after midterms as the government becomes more divided and more deadlocked and unable to pass any legislation because not one single party holds, all three branches, because that creates uncertainty. The market does not like uncertainty. So just be mindful of midterms and be mindful of earnings season coming out. Watch for new market trends of collaboration software. This is something I saw was really interesting. Despite rates putting downward pressure on mergers and acquisition activity, companies are still buying collab software and investing in their own. So I highlight the example of Adobe. With Adobe, I thought it was interesting because they just bought a collaboration software platform, or a platform as a service that allows you to collaborate on different projects within your corporation or firm. They bought Figma for about $20 billion. Since they're not public, it's hard to get your hands on any material data, but analysts from around the world estimate that the company does about $400 million in revenue. So that puts the price to sales ratio at 50. They're paying not earnings. They're paying price to sales ratio of 50. So they're paying 50 times whatever revenue Figma is doing, which is absolutely insane, because you wouldn't even really see a price to earnings ratio given the rate hikes of 50 as a market average. That would be really high and that's for earnings. Here you have it, price to sales of 50. So Adobe must see something in this company that not a lot of others are seeing. Keep your eye on that. Microsoft also launched its own collaboration software as a service to compete with Canva, which is a new startup company, most likely out of the Bay Area. Probably going to be free to use this product for a year and then added to Microsoft 365, their flagship corporate productivity program, or software as a service. And that's going to absolutely, my guess, is destroy Canva's revenue, causing them to pivot. And this is not the time you want to have a high earning blue chip stock come in and totally, throw a wrench into your corporate plans, because it's going to be very hard to pivot here in the future because of the cost of capital rising. The cost of debt is going to absolutely explode, and it's going to be very expensive to make a lot of changes in your business. Microsoft has the bundle, allowing customers to do more with less, essentially outvalue propositioning the competitor with sticky software as a service technology. So as a business, if you're using all these software products and you're paying all sorts of monthly subscriptions, it's going to be a lot better and more cost effective for you to switch to Microsoft's their bundle software as a service program that offers all these different things that you'll use: Excel, PowerPoint, Word, and now Designer, to run your business. And so I think that's another great catalyst for Microsoft. It's one of the newer companies that we bought into last year, and we're very excited to hold Microsoft, even if it's somewhat overvalued. My guess is you might see the price come down, but we will be right there buying into this quality company for its dividend, for its technology, for its intellectual property, because my theory is, as a lot of these other tech companies that continue to sell off, and you might see some sell off with Microsoft, these tech companies that are new, they're all financed with debt, They don't have stable revenue or subscription revenue, which in my opinion is the holy grail of revenue. You're going to see them become insolvent. Not the worst case scenario, but a lot of them will eventually go out of business, and companies across the board will have no other option than to integrate with Microsoft. And Microsoft's cloud platform especially is very sticky. It's one of the highest growing segments of Microsoft in its revenue, so keep your eye out for that. Going over some activity in the portfolio, we had no dividends this week. We sold, again, shaved down Pioneer, ticker symbol PXD, over the week, brought in $6,100. We're still overweight this company, and I do basically what's called dollar cost averaging. I don't hit the market makers with huge block trades, dumping thousands of shares, tens of thousands of dollars in one day, if not hundreds of thousands of dollars in one day. I slowly phase in and out of companies as to avoid intra-week, intraday volatility. I don't want to buy into a company and then have it sell off, 5-6% the next day. I'd much rather do even increments of buying or selling for these companies to avoid kind of that volatility. And in theory, it should contribute to a lower standard deviation and bring our Sharpe ratio up. Again, that's all in theory. We're still kind of testing that theory out. We bought 20 or 50 shares of MDT Medtronic for $4,100. And we bought 20 shares of Berkshire Hathaway for $5,300. We bought 25 shares of Blackstone for $2,100. I really like Blackstone for its real estate exposure. So Blackstone is a huge alternative assets company. They have a lot of exposure to a lot of real estate, and I think my belief is that real estate is somewhat undervalued right now. I have the theory that the Fed will curtail inflation. It'll naturally come down as you have some of the supply chain freezes disappear. Inflation will naturally come down and will be accelerated by the Fed raising rates. And once we enter a decent recession, if we do at all, I believe the Fed will use its position on rates to start cutting them to spur economic activity. Right now they're full pedal down on the brakes, but we could see them ease up a little bit and throw a little gas onto the fire if we do enter a recession and we do see unemployment spike to 5, 6, 7%. I think that the Fed will use the ammunition that it's built up with, it raising rates to spur economic activity if we do go into a recession, and that's going to be a perfect catalyst for real estate valuations rebounding. We bought 10 shares of Home Depot for $2,700, bought 25 shares of Costco for $11,000, almost $600. Again, that recession hedge. We have 28 holdings plus cash, and then $64,982.05 cash as of this morning. We're going to be adding to our positions through October earnings, focusing on long-term quality and resiliency.